Brian, with commercial real estate, there's a term called cap rates. Can you explain what that is?
Yeah, it's called the capitalization rate, or cap rates for short, and that helps us understand the valuation of investment real estate. So for instance, let's say that you have a piece of investment real estate and your profit, essentially your net profit from it, is $5,000. And we have a 5% cap rate. Similar properties are selling with a 5 cap. You take that $5,000 divided by 0.05, and you get, it's worth 100 grand. So for every 100 grand I invest in that building, I get $5,000 profit. That's 5% to the bottom line. That's my cap rate. So it's basically what percentage return. It's kind of like the cap rate of a CD is 1%, essentially, because you get 1% net profit on it each year. So it's kind of the rate of return that you're getting from investment real estate after expenses.
So a cap rate basically puts a value on a building, a commercial building. Do cap rates vary? I mean, is there one cap rate that basically covers all commercial real estate?
No, cap rates will absolutely vary. They'll vary by property type, by property age. So the older and more deferred maintenance a property has, the higher return I need to get. So I would require a higher cap rate if I'm going to invest in that. It's timing. It used to be that you could get really quality commercial real estate and have a 6, 7, 8, 9 cap rate and have really good income. Well, maybe right now you can't do that. Cap rate, there's something called cap rate compression that has increased the value. So let me explain that. So let's say that you have a $100,000 building, it's getting $5,000 in rents, and that's standard for buildings like that. You got a 5 cap. Well, let's say the new cap rate for new buildings, other buildings, is now 4%. People are buying them up. Well, you're getting $5,000 income on it. Your building just went up 25% in value, 25%, because of the compression in cap rates. So the less people expect to get it as a return, because everybody's trying to buy property, the more your building is worth. So as cap rates decline, and people are willing to accept less net profit from owning commercial real estate, the more your building has gone up. And that's why we've seen commercial real estate property values go up so much. It's not because people, if they went up 50%, it's not because the whole nation increased rents by 50%. That did not happen. Profits didn't necessarily change, but investor expectations did, and they're willing to accept lower rates of return, which makes property that you own worth more than it was before.
Is it important to know your cap rate to know whether or not your building is producing properly?
Yeah, absolutely it is. I remember, because a lot of people are thinking about selling their properties. Maybe it's a good time to sell. Maybe they don't want the deferred maintenance. Maybe they're getting older. They don't want to be landlords. So they're doing 1031 exchanges, maybe into Delaware statutory trusts. And so we have these cap rate discussions. And almost invariably, people will say, well, I'm making X on my building, so I want to define cap rate a little bit further. Because one of the things I hear is, they'll say, I'm making 10%. I'm like, that doesn't sound right to me. I didn't pass the sniff test. What are you basing that on? Well, my gross rents divided by what I paid for it. That is not accurate. Cap rate is determined by your net rents, net after expenses, not divided by what you paid for it. That doesn't matter anymore. Divided by what it's worth. And so, it's gone up in value, and yeah, my expenses are lower, so I'm not making 10%, I'm really making 1 or 2, exactly. And then you might have deferred maintenance, which, except when I had to replace the roof and the floor and something else, I'm really making nothing. I'm losing money holding it. Okay, exactly. So you have to be careful when computing your cap rates. You're using fair market value and actual net rents after expenses.
Brian, you've done seminars on this topic, and I understand that people sometimes misunderstand cap rates. Can you give me that example of someone who thought they were getting a lot more than they actually were?
Yeah, I had that exact thing come up. This fella was kind of snickering at me when I said what the DSTs would pay out, and I said, well, what's your cap rate? He said 16%. Well, there is no 16% real estate out there that's worth anything. So when I quizzed him on that, he finally got to where, gosh, actually, yeah, you're right. I'm more like 3, because he was doing it based on what he paid for it 25 years ago. And I said, there's other reasons why this might be important to you, because I know the fellow that was asking me the question was very not in good shape and was very old and very overweight. And I said, well, do you enjoy doing it? He's like, no, I don't. I don't think I'll be around much longer if I keep at this pace, and maybe my rate of return isn't the most important thing. I said, well, that might be a reason. So he started out kind of snickering at the thought of selling it and doing a DST. By the end, he was kind of like a commercial for him. He's like, that would be the perfect solution for me, and I could get probably even more money I'm getting now, or maybe the same, or maybe a little bit less, but that's okay because I'm getting older and I need it. So I think it's important to consider, is your real estate working for you the way it should be? Is the income proper based on actual cap rates relative to the market? Maybe it's gone up in value, you don't even know it, and that might be an important consideration when you're thinking about what to do with that real estate.
Brian, thanks for telling us more about cap rates.